The US and China set to formally ink their Phase 1 trade deal tomorrow. Now, it's an agreement that's widely tipped to ease trade tensions and bring much-needed relief for global investors. In a sign of goodwill, Washington has also announced that it will drop the currency manipulator tag imposed on China back in August last year. Now, also making headlines, data released today reveals China's export growth rose just 0.5% in 2019. That's a huge deceleration from the 10% that we saw in 2018, but in a possible sign of good things to come. December exports jumped 7.6%, up from the minus 1.3% posted in November. And for more, we're joined by Imogen Page-Jarrett. She's China research analyst from the Economist Intelligence Unit. Imogen, both sides have pledged to economically boost the other. Is it enough, though, to undo the global damage in the fallout of this protracted trade war?
Markets have reacted quite positively to the news that the US and China will sign this deal in Washington tomorrow. However, the deal in nature is ultimately quite shallow, the main aim being to prevent the next round of US tariffs on Chinese manufactured consumer goods, which would include things like toys and electronics, and therefore have an impact on the average US consumer, something that US President Donald Trump would not want in the run-up to the US presidential elections this year. Also, this deal really doesn't address any of the structural issues that started the US-China trade war in the first place, such as China's industrial policy. And therefore, business investor sentiments are probably going to remain quite subdued throughout this year.
Imogen, on the point of impacts and what we may see, we do know that in regards to China's GDP figures, they're forecasted to stall. So what sort of economic impact might these concessions have on China going forward?
I think the impact of this deal will be quite limited. The US has said that it will pull back some of the tariffs on Chinese goods, but it's not going to eliminate them completely. And throughout this year, there will be the risk that the US could re-implement those tariffs should it be dissatisfied with China's implementation of its side of the deal. And I think this risk will really continue to subdue global business and investor sentiment. And we're forecasting China's GDP growth to slow to 5.9% in 2020 from an expected 6.1% this year.
Imogen, a quick final question for you. Which specific industries in the United States stand to benefit perhaps the most from what we're going to see tomorrow?
So the US has reportedly gained a concession from China to buy $200 billion worth of US goods, and that includes manufactured goods, energy, agricultural goods, and services, and is in addition to some minor adjustments to China's existing plans to open up its financial services markets and improve intellectual property protection. However, there are definitely some limitations to these promises. For example, in agricultural goods, for example, China is basically promising to double its purchases of US farm goods over pre-trade war levels, but this is going to be very difficult. China's main agricultural import from the US is soybeans, but given the outbreak of African swine fever this year, the demand for pig feed has decreased significantly, which will make it very difficult for China to realize this pledge.